Something strange is happening in the stock market, and most investors are completely missing it. Think about this. Last year, global tariffs were announced. The market crashed. Then it suddenly hit new record highs. Weak job numbers came out, the market dropped again, then once again, new record highs. Even after major geopolitical tensions and military conflict that pushed oil prices higher and disrupted travel worldwide, investors are already counting the days until the market hits another all-time high. So the big question is, why does the stock market keep rising while the real economy feels worse for so many people? Because there are three major things broken in the market right now, and if you don't understand them, they could seriously impact your wealth and retirement. But if you do understand them, they could also become one of the biggest investment opportunities of this decade. Let me show you two numbers. The first number, $1.28 trillion. That is how much credit card debt Americans currently have, the highest level in history. It's 66% higher than just a few years ago. Have you noticed how strange the economy feels right now? On one hand, people are struggling with debt. On the other, the stock market is hitting record highs. This disconnect is what economists call a K-shaped recovery. Let's break it down. Before the pandemic, when the economy dipped, it usually recovered with everyone rising together. But this time was different. One group shot straight up, investors and asset owners. Another group went the opposite direction, dealing with higher rent, groceries, and living costs. The middle class started to shrink because, for many, there's just no money left to invest after paying for basic expenses. Meanwhile, those who do own assets are seeing their wealth grow faster than ever. This brings us to the second major issue. During the pandemic, central banks pumped a massive amount of money into the economy. They basically printed money and flooded the financial markets with it. At first it felt great. Markets surged, asset prices exploded, and even salaries started to rise. But then, prices began rising even faster. That's inflation. A few years later, central banks tried to slow things down by raising interest rates and tightening the money supply. But here's the catch. Inflation doesn't rewind the clock. Prices stay higher, so even when inflation slows, we're all still paying more for everything. Then, another shift happened. The money printing started up again to stabilize financial markets. But this time, governments themselves began directly investing in certain industries. Things like semiconductor manufacturing, critical minerals, and strategic energy resources. Instead of just regulating the markets, they started actively supporting specific sectors. This means governments now have a direct financial stake in how the market performs, especially in industries tied to technology and national security. For everyday investors, this changes the game. You're no longer just competing with other investors, you're competing with institutions that have virtually unlimited resources. Now, let's talk about the stock market itself. Most investors believe that buying an index like the S&P 500 gives them broad diversification. After all, it includes 500 companies, but here's the problem. A small group of mega-cap tech companies now makes up over 1/3 of the entire index. Just 7 companies dominate the market. These 7 companies alone have been responsible for a massive portion of the market S gains in recent years. When they rise, the whole index rises, but if they stumble, the entire market could feel the impact. So, many investors think they are diversified when, in reality, their portfolios are heavily concentrated in a handful of tech and AI giants. This doesn't mean index investing is bad. It just means you need to understand how the structure of the market has changed. The key takeaway is this. The market isn't behaving the way it did decades ago. 3 major forces are shaping it. First, a growing gap between asset owners and the average person. Second, governments and central banks influencing markets more than ever. And third, extreme concentration in a few dominant companies. That doesn't mean the market is doomed. In fact, history shows something very important. Over the long run, asset prices tend to rise. But the investors who benefit the most are the ones who understand what S happening beneath the surface. Volatility, uncertainty, and big economic shifts often create the biggest investment opportunities. If you found this breakdown helpful, share it with someone who is investing or planning for retirement. Financial education spreads fastest when people pass it forward. And if you want more breakdowns like this, explaining what's really happening in the economy and markets, make sure you subscribe and stay tuned for our next video. Understanding these changes could be the difference between falling behind or getting ahead in one of the most unusual economic periods in modern history. Thanks for watching.